Hello, we'll be doing the subtopic on interest on long-term borrowings. The learning objectives: to calculate interest expense and accrued interest expense, to record interest expense and accrued interest expense as journal entries and in ledger accounts, to prepare extracts of the income statement and balance sheet showing the presentation of interest expense and accrued interest expense. A business has to pay monthly interest on its long-term borrowings. Interest is calculated based on a yearly interest rate on the amount borrowed. When a business pays interest, the journal entry is debit interest expense as expenses increases, credit cash at bank as asset decreases. However, if at the end of a financial year, the interest expense incurred is not paid, the journal entry is debit interest expense and credit accrued interest expense because liability increases. Note that the accrued interest expense is recorded as a current liability in the balance sheet. Continuing from the example in the video clip on long-term borrowings, again on 1st September 2012, the toy shop took up a loan of $200,000 from the bank. The loan is repayable over 4 years. The repayment is $50,000 on every 31st August. Financial year end is on 31st December, and the interest rate is at 6% per annum, payable on 31st August. Let's use a timeline to better understand the payment of the interest expense. The financial year starts on 1st January 2012 and ends on 31st December every year as shown in the timeline. It is on 1st September 2012 that the business took up a loan of $200,000. On 31st August 2013, two things happened. First is the payment of interest expense on $200,000, and second is the repayment of $50,000. Let's focus on the financial year 2012. The bank will start to charge interest on the loan of $200,000 on 1st September 2012. Therefore, from 1st September 2012 to 31st December 2012, the business has to pay interest for these 4 months, which is $4,000. It is calculated based on the interest rate of 6% per annum multiplied by the loan amount of $200,000 and multiplied by the 4-month period, which is expressed in years. Since the payment of interest expense is on 31st August 2013, the $4,000 interest expense is incurred but not paid as at 31st December 2012. Therefore, on 31st December 2012, the business will debit interest expense of $4,000 and credit accrued interest expense of $4,000. So, the interest expense account will look like this. As at 31st December 2012, the $4,000 of accrued interest expense is the ending balance. So according to the Papa shortcut, the $4,000 will appear in the plus column. At the end of 31st December 2012, the $4,000 interest expense is transferred to the profit and loss of the income statement. The income statement for the year ended 31st December 2012 will look like this, with interest expense of $4,000. The balance sheet extract as at 31st December 2012 will look like this, with accrued interest expense of $4,000. Next, let's focus on the financial year 2013. From 1st January 2013 to 31st August 2013, the business has to pay 8 months of interest on the loan of $200,000, which is $8,000. Therefore, on 31st August 2013, the business will pay a total of $12,000 of interest expense on the loan of $200,000. Also, on 31st August 2013, after the loan repayment of $50,000, the business will need to pay interest on the remaining loan of $150,000 from 1st September 2013 to 31st December 2013. For this 4-month period, interest incurred but not paid is $3,000. Therefore, the interest expense for 2013 will look like this. The opening balance on 1st January 2013 is $4,000 accrued interest expense brought forward from 2012. According to the Papa shortcut, the $4,000 will appear in the minus column. On 31st August 2013, the business paid $12,000 of interest expense, so the amount is recorded in the plus column to reflect the increase in interest expense. As at 31st December 2013, there is accrued interest expense of $3,000. To determine the amount of interest expense transferred to profit and loss of the income statement, the account has to have a zero balance. The income statement for the year ended 31st December 2013 will look like this, with interest expense of $11,000. The balance sheet extract as at 31st December 2013 will look like this, with accrued interest expense of $3,000. This ends the section on interest on long-term borrowings. Click on Assignment 4 at the bottom of the page to attempt the question on interest on long-term borrowings.